For the last 77 years, there has been one reason why a major war has not broken out in Europe. One reason why the economies of Western Europe rebuilt themselves into the wealthiest continent on Earth. One reason why global trade expanded, why financial markets functioned, why the dollar remained the world's reserve currency, and why American companies could operate freely in over 30 allied nations. That reason has a name. It is called NATO. And in 2026, for the first time since its founding in 1949, serious people, generals, economists, heads of state, and bond traders are asking a question that would have been unthinkable 5 years ago. What if NATO falls apart? What if the alliance that has been the foundation of the entire post-war global economic order simply ceases to function? Because if it does, what happens to your investments, your savings, your job, and the economy you live in is not a foreign policy question. It is the most personal financial question you can ask right now. In the next 10 minutes, I am going to show you exactly what NATO is and why it matters economically, not just militarily, what the specific 2026 pressures threatening it look like, what history tells us about what happens when security alliances collapse, and precisely what you need to do with your money right now to prepare for a world where the alliance that has underpinned global economic stability for 8 decades is no longer reliable. Let me start by making sure you understand what NATO actually is at an economic level, because most people think of it purely as a military alliance, and that framing dramatically undersells its economic importance. NATO, the North Atlantic Treaty Organization, was founded in April 1949 with 12 original member nations. Today, in 2026, it has 32 members following Finland and Sweden's recent accessions. The Article 5 Collective Defense Commitment, the agreement that an attack on one member is an attack on all, is the famous military dimension, but the economic dimension of NATO is equally important and far less discussed. Here is what NATO actually provides economically. First, it provides the security umbrella under which the most productive and the wealthiest economies on Earth have been able to allocate capital to economic development rather than military spending. Germany spent approximately 1.5% of GDP on defense for most of the post-Cold War period. Japan, which operates under a similar U.S. security guarantee through a bilateral treaty, spent approximately 1% of GDP on defense. These are wealthy, productive economies that were essentially subsidized to spend their capital on factories, infrastructure, education, and technology rather than armies and weapons, because the United States was providing the security backstop. The economic dividend of that security subsidy for these nations and for the global economy that benefited from their productivity is difficult to overstate. It is measured in trillions of dollars of economic output that would not have been generated under a different security arrangement. Second, NATO provides the geopolitical stability that underpins global trade and investment flows. When an American company builds a factory in Poland, or a German company operates supply chains through the Baltic states, or a British financial firm manages assets across 20 European jurisdictions, all of that economic activity rests on the assumption that the political and security environment will remain stable enough to protect those investments. NATO is the primary guarantee of that stability for the European theater. Take it away and the risk premium for doing business anywhere in the alliance's coverage zone goes up immediately and dramatically. Third, and this is the one that connects most directly to financial markets, NATO is the geopolitical foundation of the dollar's reserve currency status. The dollar is the world's reserve currency not simply because of the size of the U.S. economy. It is the reserve currency because the United States provides global security services, protecting sea lanes, deterring aggression, enforcing the rules of the international order that other nations depend on and that they effectively pay for by holding dollar-denominated assets. NATO is the most visible and most institutionalized expression of that security provision. If NATO collapses, the implicit bargain behind dollar reserve status, we protect you, you hold our currency, begins to unravel, and the financial consequences of even a partial unraveling of dollar reserve status are enormous. So when we ask what happens if NATO collapses, we are not asking about tanks and airplanes. We are asking about the foundational architecture of the entire post-war global economic system. We are asking about the security assumptions embedded in every European equity valuation, every European sovereign bond yield, every transatlantic corporate investment decision, and the reserve status of the currency that underpins the global financial system.
Now let me tell you exactly why this question, which would have seemed almost paranoid to ask in 2020, is a legitimate and urgent question to ask in 2026. The specific pressures threatening NATO's cohesion in 2026 are not hypothetical. They are documented, they are escalating, and they are being watched extremely carefully by every defense economist, geopolitical risk analyst, and sovereign wealth fund manager in the world. The first and most fundamental pressure is the U.S. commitment question. The Trump administration's return to the White House in January 2025 brought with it the most explicit questioning of the U.S. commitment to NATO's Article 5 that has ever come from a sitting American president. In the first year of the second Trump term, there have been multiple public statements from senior administration officials questioning whether the United States would defend NATO allies that do not meet the 2% of GDP defense target, a position that, while it has been walked back and clarified multiple times, has created genuine and lasting uncertainty about American reliability. Markets hate uncertainty, and this particular uncertainty goes to the heart of the security assumption underpinning European equity valuations. The second pressure is the defense spending gap and its economic implications. For decades, the standard American complaint about NATO has been burden sharing, the argument that European allies have been free-riding on American security, while the U.S. bears a disproportionate share of the defense cost. In 2026, that argument has never been more publicly made and never more politically loaded. The United States spends approximately 3.5% of GDP on defense. The NATO target is 2%. In 2024, only 23 of 32 NATO members met that threshold, though that is the highest number ever. European nations are in an accelerating defense spending ramp-up. Germany has crossed the 2% threshold for the first time in decades. Poland is spending 4% of GDP on defense, and the UK has committed to 2.5%. But this ramp-up has economic consequences. Defense spending is not free. The capital being redirected toward military spending in European economies is capital that is not going into infrastructure, education, social services, and productive investment. The economic cost of the NATO cohesion crisis, paid by European taxpayers, is already measurable. The third pressure is the Russia-Ukraine dimension that gives the alliance question the immediate urgency. The war in Ukraine, now in its fourth year in 2026, has been the most significant test of NATO cohesion since the alliance's founding, and the test has been imperfect. There have been disagreements about the pace of weapons delivery, debates about escalation thresholds, political tensions about the economic cost of sanctions on Russia, and questions about the long-term commitment of various member nations to sustaining Ukrainian resistance. The war has simultaneously demonstrated that Russian military aggression is real and present, reinforcing the case for NATO, and exposed genuine fault lines in European-aligned unity about how to respond. Both things are true simultaneously. The fourth pressure is internal political fragmentation within NATO member states. Right-wing and nationalist political movements, some with explicitly pro-Russian sympathies, have gained significant political ground in multiple NATO member nations in recent years. Hungary, under Viktor Orban, has been the most prominent example, consistently blocking or complicating NATO consensus decisions, maintaining energy relationships with Russia, and questioning the wisdom of Western support for Ukraine. Similar political movements have grown in strength in Slovakia, in parts of Germany, in France, and in Italy. The internal political cohesion of the alliance, the shared values and shared threat perception that made NATO work for 8 decades, is more contested than any point in living memory.
Now here is the question that every serious investor should be sitting with right now. You do not need NATO to formally dissolve, to hold a vote and issue a press release saying the alliance is over, for the economic consequences of NATO fragmentation to materialize. The economic damage begins the moment serious doubt about the reliability of Article 5 becomes embedded in market expectations, and that embedding is already beginning. Let me take you back through history, because the consequences of international security order breakdown have been written before, and the economic record of what happens when the security architecture holding the global order together fails is one of the most important and most underappreciated lessons in financial history. The most directly instructive historical parallel is the collapse of the international order in the 1930s, specifically the failure of the League of Nations and the unraveling of the post-World War I international security architecture.
The League of Nations was established after World War I with the explicit purpose of preventing another major conflict through collective security, the same basic principle as NATO's Article 5. And it failed. Not because it was formally dissolved in a single dramatic moment. It failed gradually, through the incremental withdrawal of major power commitment, through the failure to respond credibly to acts of aggression in Manchuria and Ethiopia, through the internal political fragmentation of its member states between democratic and authoritarian movements. And here is the economic consequence that most people do not appreciate. The collapse of the international security order in the 1930s did not just produce World War II, it produced a decade of economic contraction, trade collapse, currency crises, and capital flight that began years before the first shots were fired. Global trade fell by approximately 65% between 1929 and 1932, driven partly by the Great Depression, but amplified dramatically by the geopolitical uncertainty and the trade protection and currency devaluations that nations adopted as they stopped trusting the international order. The Smoot-Hawley tariff, America's most famous trade protection measure, was partly a response to the sense that the international order was breaking down and that economic nationalism was the rational response. The lesson is not that NATO's fragmentation would produce World War III next year. The lesson is that the fragmentation of international security orders produces economic consequences: capital flight, risk premium increases, trade contraction, currency volatility that precede the worst political outcomes by years. The investors and policymakers who reacted to the early warning signs of League of Nations failure in the early 1930s, who moved capital to safer jurisdictions, who reduced exposure to the most vulnerable economies, who held gold and stable currencies, were better positioned than those who waited for the definitive crisis event. The other historical parallel that is worth understanding is the end of the Cold War and German reunification, but run in reverse. When the Berlin Wall fell in 1989 and German reunification happened in 1990, the collapse of the threat that had made NATO's cohesion automatic produced what became known as the peace dividend. Defense spending fell across NATO member nations. Capital previously allocated to military spending flowed into productive investment. European integration deepened. The Maastricht Treaty created the euro. The 1990s were a decade of extraordinary economic expansion, partly because the security environment had dramatically improved and capital could be allocated more productively. A NATO fragmentation scenario is the peace dividend in reverse. Instead of the security environment improving and freeing up capital for productive investment, the security environment deteriorates and forces capital toward military spending, risk mitigation, and defensive economic arrangements. Every euro that Germany spends on tanks in 2026 is a euro that is not going into Volkswagen's EV transition or Deutsche Bank's technology infrastructure. The economic cost is real, it is measurable, and it is just beginning. All right, here is what you actually do with your money in a world where NATO cohesion is genuinely in question. And I want to be completely direct about this because the implications of geopolitical security order fragmentation are real, they are significant, and they are different from the investment implications of normal economic cycles. Standard disclaimer, nothing here is personalized financial advice. Your specific situation requires a qualified professional. What I am giving you is the framework that geopolitical risk specialists and institutional sovereign wealth fund managers use to think about security order transitions. The first investment implication, and the most immediate, is European equity risk premium repricing. European equity markets are priced on assumptions that include a functioning NATO security umbrella. If serious doubt about that umbrella becomes embedded in market expectations, the risk premium demanded by investors to hold European equities goes up. Higher risk premium means lower valuations, not because European companies are worth less intrinsically, but because the discount rate applied to their future earnings increases to reflect the higher geopolitical uncertainty. If you have significant exposure to European equities through international equity ETFs, European-focused funds, or individual European company stocks, understanding this repricing risk is essential. It is not a reason to have zero European exposure, it is a reason to be thoughtful about how much and to hold it with eyes open to the specific geopolitical risk. Second, and this may seem counterintuitive, defense sector equities are one of the clearest beneficiaries of NATO's stress. The fragmentation of NATO's burden-sharing arrangement, with European nations now dramatically increasing defense spending, is a revenue opportunity of historic proportions for defense contractors on both sides of the Atlantic. European defense companies, BAE Systems in the UK, Rheinmetall and Airbus Defence in Germany, Leonardo in Italy, Thales in France, are experiencing their most significant growth periods in decades as European governments accelerate procurement. American defense contractors, Lockheed Martin, Raytheon, General Dynamics, Northrop Grumman, benefit from both U.S. defense spending and international sales to allies who are rearming. The NATO cohesion crisis is terrible news for European taxpayers and for the geopolitical stability that underpins economic growth, but it is very good news for companies that make weapons, aircraft, missiles, and military technology. Defense ETFs that provide exposure to this theme, funds like ITA in the US or the various European defense sector ETFs, have been among the best performing equity investments in 2025 and 2026. Third, currency positioning. In a NATO fragmentation scenario, the currencies of the most exposed NATO member nations face depreciation pressure from increased defense spending, higher sovereign borrowing, and elevated geopolitical risk premiums. The euro, which represents the collective economic weight of Eurozone members who would be most directly exposed to a weakened NATO, faces particular pressure. Against that, the Swiss franc, which has historically been a safe haven currency in European geopolitical crises, partly because Switzerland is not a NATO member and maintains genuine neutrality, tends to appreciate. The US dollar, which benefits from flight to safety flows and from its reserve currency status, also tends to strengthen in European geopolitical stress scenarios, at least in the short term. If you hold international investments, understanding your currency exposure in this context is important. Fourth, gold. I keep coming back to gold across multiple risk scenarios, and that is because gold is one of the very few assets that tends to hold its value across a wide range of adverse geopolitical and economic scenarios. In a world where NATO's reliability is genuinely in question, where European rearmament is driving fiscal pressure on sovereign balance sheets, where the dollar's reserve status might be affected by long-term alliance fragmentation, and where the geopolitical risk premium across multiple asset classes is rising, gold is one of the most straightforward stores of value available. In 2026, gold is already above $3,000 per ounce. In a genuine NATO fragmentation scenario, its role as a geopolitical safe haven would likely drive it significantly higher. Fifth, for bond investors, be very thoughtful about European sovereign debt in the most exposed nations. The Baltic states, Estonia, Latvia, Lithuania, are the NATO members most directly exposed to Russian military threat and most dependent on Article 5 for their security. Polish sovereign bonds carry more geopolitical risk than German bonds. If NATO Article 5 reliability declines, the risk premium on the sovereign debt of frontline NATO states increases, meaning bond prices fall and yields rise. This is not a reason to exit European fixed income entirely, but it is a reason to be aware of geographic exposure within your international bond holdings.
Let me give you the honest, big-picture assessment that ties all of this together. NATO is not going to collapse tomorrow. It is not going to hold a vote, issue a formal dissolution statement, and close its headquarters in Brussels. That is not how alliances fail. Alliances fail gradually, through incremental credibility erosion, through the accumulation of moments where the commitment is questioned and the question is never fully resolved, through the growing gap between the formal commitment and the practical certainty that it will be honored. What we are watching in 2026 is the beginning of that credibility erosion process. It may be reversed, a shift in U.S. political direction, a dramatic Russian act of aggression that reforges Allied unity, a successful European strategic autonomy arrangement that reduces dependence on American commitment. These are all possible, and the outcome is genuinely uncertain. But the financial markets that reflect geopolitical risk do not wait for certainty. They price probability distributions, and the probability distribution around NATO reliability in 2026 has shifted significantly compared to 2019 or 2015. That shift from near certainty to meaningful uncertainty is enough to affect valuations, risk premiums, currency dynamics, and capital allocation decisions in ways that matter for everyday investors.
The world that NATO enabled, the world of low European defense spending, deep transatlantic economic integration, stable European political environment, and the dollar reserve currency underpinned by American security provision is being stress tested. The stress test may pass, but the stress is real, and understanding what is actually at stake economically when people talk about NATO cohesion, puts you in a fundamentally better position than the majority of investors who think this is purely a foreign policy conversation happening somewhere else. It is not happening somewhere else. It is happening in the risk premium on your European equity ETF. It is happening in the defense budget allocations that are redirecting European capital away from productive investment. It is happening in the conversations at every major central bank and sovereign wealth fund about what a different security architecture means for dollar reserve status. It is happening in your portfolio whether you know it or not. Here's what I want you to walk away with today. NATO is the most important and most underappreciated economic institution in the world. For 77 years, it has provided the security foundation that allowed the wealthiest economies on Earth to allocate capital to growth rather than defense, that underpinned the global trade architecture, and that provided the geopolitical foundation for dollar reserve currency status. In 2026, for the first time in its history, that foundation is being genuinely stress tested by American political uncertainty about the commitment, by European political fragmentation, by the ongoing challenge from Russia, and by the broader erosion of the post-war international order. The investment implications are real, and they are already beginning to materialize in European defense spending ramps, in equity risk premium adjustments, in currency dynamics, and in gold's continuing rise. The response is not to panic, it is to be informed, to understand European equity exposure, to consider defense sector positioning, to maintain gold and safe haven currency exposure, and to watch the alliance's credibility signals with the same attention you give to Federal Reserve communications, because in terms of their impact on global financial markets, they are equally important. Drop a comment below. Do you think NATO will hold together through the rest of this decade? And have you made any portfolio changes based on European geopolitical risk? I genuinely want to know your read on this. I read every comment. If this video changed how you think about the connection between geopolitics and your portfolio, hit that like button. One click genuinely helps this reach more investors who need to think through these risks. Subscribe if you want macro intelligence that connects global security dynamics to your personal financial decisions. Turn on notifications and share this with one investor in your life who thinks geopolitics is someone else's problem. Coming up very soon, we're going deep on what the collapse of the dollar's reserve currency status would actually mean for your savings, your mortgage, and every dollar-denominated asset you own. That video connects directly to everything we talked about today. I will see you there.
Subscribe to Investify. More financial videos, real insights, zero fluff. Let's build wealth together.